welcome to Prescient Investment Management's H2 webinar with me, Joanne Bainham. Today I'm joined by various faces around this table that you all know very well. We'll be chatting to all of them today, so please stay focused. We've got 5 acts to get through today, 5. The first one is Act 1, what actually happened in 2025. So Basti, exciting year, pretty much every single asset class went up. From your perspective, what forces ultimately drive asset class performance?
Thanks, Joanne, and thanks to our viewers for switching in. I think 2025 indeed has been a great year. We had, as you said, very good asset class performances. The clients which are invested with Prescient also had a lot of alpha on top, so throughout, I guess, through and through a very good year. What has driving it or driven it, I think many different forces. Probably what, maybe to start at that point, what didn't we get right or what missed we, or what was basically a little bit of a surprise for us was the very resilient US economy. So we didn't see it rolling over either, but maybe the extent to which the US economy surprised on the upside was a little bit of a surprise for us. And with that, on top of that, also the strong US equity market. So that was kind of a little bit of our pain trade. Having said that, there's always something you get wrong, other things you get right. Luckily, we got more right than wrong this year. And if we look back, speaking about this pain trade or this very strong US equity market, emerging market equities performed even stronger. We got that right. SA government bonds rallied very strongly, which we also got right. We had a long duration position almost until June, July, so for the majority of the rally. Income assets performed very well. Income provider funded more than 10% of the fees, almost 11%
That's
for fees.
incredible for cash.
Yeah, so very good returns. And with that, I guess, the drivers mostly have been global in nature, less inflation than expected. That's what we got right. More growth than expected, and just throughout macroeconomically very strong news. Okay, so next question is for you, Risa. Probably the most exciting event in the bond markets in 2025 was the 3% target from the SARB. What impact did that have on nominal bonds in South Africa?
First, thanks, Jan. So I think, just to start off, I think what we effectively saw was something of a structural recalibration of the yield curve to lower inflation through the cycle or equilibrium inflation, right? So normally, the area of study there is normally break-even inflation. Break-even inflation is commonly thought of as being the sum total of inflation expectations, but they actually contain 2 different components, and it's important maybe to distill those 2. So the first component is your average inflation expectation, which has drifted lower. Remember in 2016 or 17, the SARB introduced the quarterly projection model, and that sort of calibrated inflation to around 4.5%. What we've now seen is that 4.5% has begun to drift lower and will gradually, in the fullness of time, based on the credibility of the SARB, drift towards 3%. So that was the first change. The second one is that South African nominal bonds embed an inflation risk premium. So this is effectively a little bit of a price that the market charges for the fact and the probability or the chance that inflation might uncomfortably overshoot to the upside. So what we see in the South African case, and the literature is quite deep about what generally happens in other emerging markets that have also lowered the inflation target, is that the inflation risk premium rapidly collapses. So we had an inflation risk premium of about 1% here in South Africa that rapidly reduced to just above 0, right? So we're talking about 20 or 30 basis points from a value of about 1%. So you take both elements of the gradual convergence towards a lower point estimate of around 3%, and you take that collapsing of that inflation risk premium, that dissipation of that kind of very, very adverse uncomfortable inflation overshooting, and you put those things together and you see basically the sum parts of the massive bull rally that we saw in the South African bond market. So effectively, one needs to examine break-even inflations, and the dual components of that both compressed very meaningfully.
Okay, so that was local fundamentals that drove the SA bond market. Yeah. Was there anything on the global scale that also drove the bond market?
I think if we look at the monetary landscape globally, was largely unchanged, right? I don't mean completely unchanged as there was no changes to policy rates, but everything largely stayed in line with expectations. You had a weaker dollar. The reaction function of the Fed largely followed what was anticipated by market participants. So there wasn't any large-scale changes to the global policy landscape. So I think this is much more in contradistinction to what we normally say. We still believe the bond market, South African bond market, is driven by global factors, but in this particular case, the global factors were largely static, the key global factors.
But we did have a very weak dollar, and people were chasing emerging market currencies. Did that not impact the bullish nature of our SA bond market?
I think so. I mean, that is a big part of it. I think that very few proponents of global capital, those that normally participate in the global carry trade, very few of them actually take naked positions of the South African bond market. So essentially what you have is that they would take a position in South African rand bonds and hedge the currency.
Okay.
Now, with a weaker dollar and basically with narrowing inflation differentials, the actual cost of the hedging has actually become a lot cheaper. So even though our yields have compressed, the cost of hedging your rand exposure has become cheaper, which in a way still makes it quite attractive. So the dollar, in a way, did also have a little bit of a role to play in foreign capital reasserting themselves in the South African market.
Yeah, I guess by reducing hedging costs, then it's more attractive.
Absolutely.
Okay. Ramalon, equity markets. Wow, I mean, you made so much money in SA equity this year. Were you very long gold, very long platinum? Talk to me about what happened.
Thanks Joanne, before we talk about the SA market and contrast it with global markets and broader emerging markets, so the equity market overall had stellar performance. We can just measure that by the MSCI All Country Index, which is up 22% for the year. Pretty much even performance in the first half and second half, so you can see how the momentum from the first half just carried through. And like with equities, it's volatile. And there were many risks, just to mention a few, with Trump's tariffs, the war in the Middle East, uncertainty about inflation and monetary policy. It's crazy to believe that the performance on Liberation Day it's reflected in the numbers, and the market's still up 20% globally. On the developed market side, the MSCI World was up 20% as well, and that was driven by strong earnings and the increasing sentiment on AI. It is important to note that European markets and Japanese markets outperform US equities, which is quite interesting. The European stock index was up 42% in dollar terms for the year. On the emerging market side, as I said, emerging markets did outperform their global counterparts, and that was probably because of risk-on appetite as rate expectations came through. And the Chinese market bounced. Chinese market was quite flat for the first half of the year, up about 0.3%, and then it was up 20% for the second half of the year. So the Chinese market, together with the resource boom, as I'm going to talk about South Africa now, resulted in such a great performance for emerging markets. Coming to South Africa, our performance was 43% for the year, which is almost unheard of. 12 consecutive positive months. I was looking at the data. I don't think that's happened before in the South African market. And largely driven by resources, up 130%. Initially, we thought it was gold, but PGMs also came through. Some platinum stocks up over 200% for the year. And I think telecommunications was a surprise. There's some positivity on cash flows there that result in the telecommunications sector being up about 72% for the year. Financials and technology both had one good half of the year, and their performance was a bit subdued, lower than the 43%, but still high double-digit numbers. And that proved why South Africa was the outperforming equity market of the year.
And that's a question here that's not on your board here. But now you've got some incredible numbers, both globally and in South Africa is clearly a winner. Did you see large flows coming in? Or did the flows come in after the performance?
I think money usually chases performance, and we're seeing the flows start to come in. But I don't think many people predicted that the equity market is going to run 43%.
Yeah, it's simply unbelievable.
At the start of the year.
No, it's incredible. Okay, Rupert, we've just discussed this. Strong bond markets, strong global equity markets. You know, pretty much it would be hard not to make money in 2025. Tell us more about it. Was there anything that surprised you in 2025?
Thanks. Yeah, so I think everything's relative. And you say it's hard for people not to make money. I think pretty much every fund in South Africa made money in some way last year. There were one or two that didn't, I'm not quite sure how. But Yeah, it was a tough year not to make money. The difference, though, is making more money than the next mix of asset classes. And if we talk about what we were positioned in coming into the year, we had an overweight position in SA equities, we were neutral on emerging market equities, and we were underweight US equities. So if you take the three of those, and going back to Ramelin's examples on how those performed, we had, let's say, 40% in SA equities, so that one went really well, and we've since turned to slightly underweight in SA equity category. We had 30% roughly in emerging market equities, also went really well, and we had 20% in US broad-based developed market equities. But the 30% and the 20% were dollar-based. If you price that back to rands, and this is a big mover that many people don't talk about, the rand strengthened 12% last year. So you would have lost out that 12% if you had as a rand-based investor, if you'd taken your money, put it offshore in US equities, made 20%, but lost 12 on the rand. You would have ended up with 8%. Now, Henk and the income fund made over 10%. So just to put it in context, everything is relative. And for us, we were underweight US equities. We took that weight off. We put it in low risk, front-end income type asset classes. And that went quite well for us. The trade came through. It came through ahead of US equities. And we didn't have that overweight towards risk asset classes.
Okay, we're now ready for Act 2. Signals, credibility, and capital flows. Rusty, you're a systematic house. You do things with quants, with numbers. We all try and understand you guys. But what is the single most important definitive signal guiding your current views?
Yeah, Joe, I think we get that question quite often, but I think the strength of our process is to not rely on one single factor. So we're trying really, and just to recap, our approach is really all about blending a lot of factors, many drivers of market returns, and then try to figure out which are the most important ones at given points in time. So just citing one, I'll cite three. The first one definitely is valuations across asset classes. I think that's different this year compared to last year. Last year, we all were priced for cheap SA equities, cheap SA bonds, potentially undervalued currency. But now all of these asset classes have rallied. So valuations are different this year in a way that every asset class which we spoke about so far is much more expensive. Second big driver is the global economy. So we do know that the South African market and obviously global markets are mostly driven by global factors. We get lost in the headlines and are very positive about coming off the grey list or basically having a good budget, potentially more political stability, no load shedding. All of that is great and important for the country, but when it comes to drivers of capital markets, global economics matter much more. If you look into the global economy, it's very resilient. It's probably might stay resilient this year. We know why it's resilient. It's because of massive productivity gains. We think a lot of it driven by massive improvements in AI or technology in general. But we do think there's a risk that is potentially overrated. We're not worried that it's overrated. We think it's one of the biggest trends of the century. But the reality is that the unemployment rate in the States keeps on creeping up. That historically has been a very bad predictor in a way that means weaker asset class returns. So that's the second factor. And I think the third big factor is sentiment. So this already leads into sentiment. Everybody's positive about productivity gains. Nobody's worried about the weaker labor market. So what does it mean? Market participants are complacent. We don't like to just say it. We also don't like to say market is up 40%, now it can't go up another 40%. We like to measure it more scientifically. So what we can do is we can look into option pricing and how much market participants are willing to pay for crash protection, insurance against market crash, and those numbers are very, very low across asset classes. So basically, if I combine everything I just said, this year we've got expensive valuations, got an economy which is potentially, I don't want to say weak, certainly not weak, but potentially overrated in terms of its strengths. And last but not least, measurably, nobody's worried about anything. And if nobody's worried about anything, we do get worried. So the combination of these factors are the driving ones this year.
Just on your last point, are you guys buying insurance then in your portfolios? So is it like you stay long but you buy some insurance alongside it, or are you taking chips off the table?
Yeah, I think we're taking chips off the table across the board, just being slightly more cautious after those negative factors now basically outweighing the positives. Do we use hedging strategies and derivative strategies? Certainly. I mean, Rupert already highlighted that we've done that quite successfully last year in the currency space. So being smart on choosing the right derivatives at the right time is always part of our toolkit, and certainly that will be quite relevant this year again.
Just one more question, but is that protection at the moment cheaper than it's been for a while because nobody wants it.
That's exactly right. So that's what we see. That kind of makes a point to maybe buying it because it's cheap, but it needs to obviously fit into your overall positioning, which for us right now it does quite well because we want to be more cautious anyway.
Okay. Bond markets, stellar returns in 2025. We're all pretty aware of that now. Saab comes out and says 3% target. Hot air or credible? Tell us.
Yeah, so massively credible. So as I was alluding to in the first question, I mean the literature around what actually happens in emerging markets once a central bank communicates a lower target is massively deep, right? You know, and it's quite remarkable how similar South Africa is to a range of other emerging markets that have done similar actions via their central banks. Indonesia is an example that comes to mind. The Philippines, Paraguay, Uruguay both moved to 3% inflation targets with the reactions of their bond market, exceedingly similar, right? So the question is, what characteristics of those respective central banks can be shared with the Saab? And the literature conclusion, and what we've seen certainly in South Africa, is that conditional on the central bank being very credible, as we believe our Saab is, the transmission mechanism to that initial forward guidance about what they're going to do and what then subsequently materializes in the bond market is almost instantaneous, right? So if the market did not believe that the Saab was credible, if the market did not believe in the Saab's reaction function, that's a big word, but it's basically how they conduct monetary policy. If the market did not attach a great degree of credibility on the Saab, we would not at all have seen this massive structural recalibration lower of the yield curve. We in fact have seen that, and the efficacy of that transmission, the effectiveness of that transmission was so efficient it almost resembled something that one would normally associate with the first world or very developed world country. So massively credible. But I don't want this argument to almost sound very, very subjective. A very clean and almost mathematical way in which you can assess whether a reserve bank is credible is to basically look at what is the mandated inflation target and how far are long-term inflation expectations away from that. I'll give you an example. At the height of the post-COVID experience, we saw inflation in the US at 9%. But at no time, even in that very, very outsized inflationary episode, did long-term inflation expectations in the US ever step out of kilter. In the US wants 2%, and the most that long-term inflation expectation moved was about 2.4% away from 2%. So the gap between that, very, very low. Again, here in South Africa, the Saab now wants 3%. Long-term inflation expectations are hovering around that point, and that's the cleanest litmus test that the market is attaching a degree of credibility to the Saab, a great degree of credibility to the Saab.
I don't do your job, but I'm a bit confused about this 3% target because administered prices in this country continue to be way north of the 3% number. How does higher interest rates bring in an inflation target down to 3%? And how does it not throttle growth in this country? And maybe just explain that the bond market might believe the Saab, but I still think the man in the street doesn't believe it.
It's quite a classic question. So
I'm glad I asked a classic one.
Yeah, quite a classic question. So the first one, right? So the movement to a 3% inflation target is not a trade-off against growth. And the common retort or the common antagonistic position is to say, you are now pursuing 3%, that will automatically mean hawkish policy rates. That is incorrect. So what actually happens is that you have a nominal policy rate, but because the Saab was so credible, again this credibility issue, inflation expectations repriced immediately. So you had the Saab's nominal rate where it was, inflation expectations moving from 4.5% to 3% almost overnight. That actually means that you are now sitting with a more punitive real rate. That real rate has gotten wider because your inflation expectations have got lower. Now, a more punitive real rate actually means that you must now pursue lower policy rates in pursuit of a lower inflation target. That kind of logic has not been very, very well appreciated by many economic commentators. So very, very ostensibly, you could now see a cutting cycle even though we are pursuing a lower inflation target.
Because real rates are higher.
Exactly.
Okay.
Your growth argument. So how does that really help the story? That helps the story because essentially the problem, one of the fundamental structural problems that you have for the growth impediment in South Africa is an excessively high cost of capital, right? And effectively what this does is because it massively shrinks your equilibrium inflation assumption, it means that your long-term cost of capital lowers. It means the propensity or the likelihood that business would want to embark on fixed capital expenditure now goes up because that long-term hurdle rate has come down. Businesses will now invest in fixed capital expenditure, and that can act as a springboard for long-term growth. Now, all of this, what I'm saying now, was very, very well choreographed in the documentation that accompanied Lesetja's remarks when he first started these comments about a low inflation target back in March. Very few, in my experience, very few economic commentators actually read the documentation. But all of this basically was very coherently explained, and it's very easy now to make a constructive case that you're pursuing lower inflation, bond yields come down, the long-term cost of capital comes down, and you can do that with lowering policy rates. It sounds like a win-win to me.
It does. It sounds, why didn't you do it earlier?
Yeah.
Okay. Conway, this credibility now goes into the corporate bond market as well. Tell us more about that.
So I think just to reflect on 2025, it was quite an interesting year for the debt capital markets or the credit markets. As a systematic house, we use a host of signals to which ultimately results in our credit cycle indicator. A credit cycle indicator, as Basti and Riza has spoken about, the macro, local and global is looking significantly more positive. We're seeing better performance locally, earnings coming out, as Ramalan said, for local and global entities are actually looking much better. But I think the story of the credit markets is we've got all of these positives, but it's almost as if this has been priced for perfection. So what that talks to is Basti's point on valuations. There's been a significant amount of investor demand for assets which continue to drive down spreads. So that when I say priced for perfection, there is not a moat, or there's not enough space for error in terms of how much you actually earn on corporate instruments for the relative level of risk. Relative level of risk has improved, but it's not commensurate with the sort of return that you are earning. So that is.
So credit markets are still expensive.
It's significantly expensive and priced for perfection. So what we have been doing here is we continue to be, as a house, defensively positioned, because we know that in the credit space, we do suffer from limited liquidity on certain instruments, but the pricing continues to go down. If we're just looking at NCDs coming in, we're looking at senior pricing coming in on banks by 20 bips, additional tier in one instruments well in excess of 50 bips. So some instruments at all-time lows from a spread perspective. So I think the pricing there is not necessarily commensurate with what's happening from a fundamental perspective, even though we are seeing improved fundamentals.
But just remind me, you guys do a lot of origination of debt as well, don't you? You don't rely purely on the bond market to give you deals.
So we do bond market, we do debt capital
But I'm
markets,
saying in the credit markets, you do a lot of your own origination.
Yes. So in that instance, it gives us these opportunities to focus on quality. So we, again, look at relative value and quality. We're actually looking at variables such as auctions, auction pricing, bids that are happening, secondary and primary liquidity in the markets, secondary and primary trading across markets to see where we can get pockets of value. So defensively positioned, but we have our own origination function that can actually service Rupert, Riza, Ramlan, and Henk's funds to make sure that we can actually still deploy capital. And I think that is sort of something that sets us aside. And again, our systematic approach makes it a bit easier for us to originate, or at least let our partners know what type of assets that we do want.
Okay, the cash market, Henk, it's your turn.
Finally.
Finally. Were there any potholes that we should know about, opportunities in 2025?
Yeah, thanks, Joanne. And certainly, so we've gone down the risk spectrum. Not as exciting as some of the other asset classes, but in our world, in the front end of the SA yield curve, real yields are still and was exceptionally high. I mean, you made a comment earlier when Basti said 11% for cash, basically. On the income side, is unheard of.
Yeah, I'm still constantly amazed at how high the real yields are for short-term assets. I think it's one of South Africa's biggest issues, but that's another story for another day. Carry on.
Yeah, so the income provider, just to harp on that point, income provider turned 20 years old on the 31st of December last year. Okay, last year's performance was the second highest real return in its history.
Good grief.
Only second to 2024. Okay, so we've been telling the story to clients. It's Goldilocks. but we should make the most of it. And that's what we did. Talking about sort of opportunities, Conway mentioned NCDs coming closer or coming tighter. We did have a % of rate cuts. So at the start of the year, we took advantage of fixed rates, a lot of duration. We fixed a lot of our front-end rates as well. NCD started out around 850. It's now around 750. So there's a nice % compression. So a lot of those opportunities came through in the first part of the year. Our view changed slightly on duration, sort of call it around August. We took a little bit of a step back. So you asked the question around hedging and pricing, etc. So as Basti said, we took some risk off, but in the income funds, we also added a bit of protection. Okay, so keep your long position, but add a bit of protection as well because of the nature of the pricing in that space. So a lot of opportunities, not that many potholes. I think the key pothole is there's a lot of cash in that space and not a lot of assets, as Conway said. So for us, the pothole would have been chasing those assets at the wrong spreads, right? And an example of that, and to Conway's team's credit, see, that's a nice pun there for you.
Very clever. I heard it, yeah.
Yeah, you got it. You made a point around origination. We originated or sourced Transnet exposure, government guaranteed, about 3 weeks before Transnet came to market. And the difference between where we would have received our pricing and what the market then eventually priced them at was a big delta, a big difference. So we find those opportunities. The pothole would have been going into the auction and not do our own work. But yeah, we missed that pothole.
Well done. Okay, guys, we're now moving on to Act 3, Flows, Alpha and Portfolio Construction. Riza, it's a question for you. Okay, I'm going to try and get the wording right here. Do foreigners drive yields lower in South Africa? Or do the yields in South Africa pull in foreigners? Chicken and egg, what starts it? Which is the bigger force?
Yes, another classic. Yeah, so it's not actually straightforward to identify, let's just call it bidirectional causality either way. In other words, there's no one can't say no, it's purely the influx of capital that moves yields, or the other way around, it's purely the attractiveness of yields that pulls capital. I'll give you an example both ways. So if you have a massive amount of a big ticket size, so a massive amount of global risk-seeking capital that comes into our commercial dealer banks, relative to the market depth size and relative to the prevailing positions of those dealer banks before they came in, then indeed a massive ticket size can move yields, right? So that direction can certainly happen. But it's not always a given that a massive amount of inflows will necessarily result in yield compression. It's not a given. As I say, it depends on market depth and it depends on what kind of risk was already on the dealer books, the guy sitting on the other side of the trade, receiving the foreign flows, usually a dealer bank. The other way around is that, let's just say, and this is more to some of the points that we usually make, if global conditions conspire such that you have low developed market policy rates, low developed market risk rates volatility, ample liquidity in the commercial banking system in developed world, and also ample dollar liquidity, those conditions generally conspire to make high carry emerging market destinations like South Africa look attractive. And that tends to pull flows in the classic type of portfolio rebalance channel where risk-seeking capital moves to South Africa, Mexico, Brazil, Poland, that kind of thing. So it can work both ways. There's no bidirectional easy answer. I would say both flows and yields are themselves both subject to a set of exogenous or external global factors that can affect both. So not an easy answer, and I'm afraid we won't get our definitive answer to the chicken and egg story today. But there's good evidence on both ways. There's bidirectional evidence in both ways.
So given what you've just said, what do you do with that information when you're running bond funds?
So, I mean, we've largely, so, I mean, a good example would be to look at about the past 2 years. So the past 2 years was a very good example of, well, some could almost describe it as the death of the carry trade. So post the financial crisis, you actually had a situation where the policy rates in the developed world were close to zero, and you could basically borrow at close to nothing, and that capital needed to find a home. that capital then went to places like, as I said, South Africa, high carry emerging markets, right? That situation changed extremely abruptly when the US started to embark on their very aggressive hiking cycle circa March of 2022. So what then happened there was that you had very, very high front-end rates in places like the US, something that was extremely atypical after the financial crisis. And we commonly use this example, acting like a Hoover machine for global capital. So the hurdle rate to want to go and explore emerging market high carry destinations was scuppered by the fact that you could get such a good deal back home in the US with front-end rates being so high. So the way we use it is we use it to frame the discussion about what is likely to happen to growth global risk-seeking capital. Are they likely to be tied up in places like the US front end, or are they likely to start looking for other homes like South Africa? And the story that we spoke about first, about the chicken and egg, the flows yield story, it helps us to frame that and to almost make an assessment. Everything is measured econometrically, of course, as you know, Prescient, but it helps us to frame the discussion from a contextual perspective. Now that is beginning to change, as we know that globally policy rates are on their way down. And that is starting to result in some green shoots in our weekly auctions. We've seen greater foreign participation and things like that. So it does help to frame the discussion more than anything else. That's how we use the information.
So funding at home has got cheaper in America, and they're starting to look for extra carry somewhere else.
Exactly, green shoots along those lines.
Okay, and then you've talked about the 3% target already.
Yes.
So there's quite a lot of very positive news
absolutely.
on the SA fixed income market.
Absolutely.
We've discussed global equity markets and local equity markets. One of the big drivers of returns, Prescient as a house, is your portable alpha strategy. Has it helped again in 2025? Tell us more about it.
Yes, it did work. The equity funds have done 47%, while the index has done 43%. So clearly, it's worked. And the thing is, you asked if we refine the model. We constantly refining the model. A lot of our resources invested into research and how to optimize these to taking the risk into account. So if you ask what has changed from the previous time, is that we've become more risk cognizant, and we're always seeking to optimize for risk. And what investors can expect is a high degree of certainty in equity market performance with a high possibility of outperformance consistently and reliably.
Okay, now the credit fund, Conway. Have you made any changes on your strategies and what you're doing? Anything that you've changed?
So no, we haven't. We still follow our deeply systematic approach to credit. As I mentioned earlier, the pricing or the valuations just continue to be priced for perfection. So with that in mind, we focus on quality, which means marrying the top down, the macro, which we rely heavily on Riza's sort of research. And then also what my team does is not only originating, but finding sort of nuggets within a space where there actually isn't a lot of issuance. And yes, in our space, anything can go wrong when you are priced perfection, but if you have a moat, then it helps you. Right now, there isn't that moat. Too expensive credit market in the local and global context.
To be fair, Conway, you've been very consistent in this view. I think I've interviewed you for a couple of years now, and you've consistently been saying that. So
And to be defensively positioned is rough. But to go to Henk's point, getting that Transnet trade really did help us. Yes. But we also did participate in the auction, but the pricing was crazy. And then you're in a position where 81 is at record lows, 50 bips. NCDs and the likes have come in. So I sound like a broken record, of course.
Oh, no, I'm complimenting you. You've been consistent. I think that's very good in markets. One should be consistent and stick to one's process, and you have. So well done. Rupert, asset classes, where are you finding opportunities in this specifically regarding to your objectives? In other words, higher risk and lower risk. Where are you seeing opportunities?
Yeah, so just coming back to it's important, the inflation part of this whole narrative. Yeah. So investors have got to keep in mind that inflation has now, the central bank policy rate targeting inflation has come in. So a high equity fund that targets CPI plus 6 and a low equity fund that targets CPI plus 4, that CPI component has now compressed. So a lot of people think mistakenly in nominal returns. In terms of their investment outlooks. So the classic example is someone bought a Coke in 1980 for 50 cents, and now they buy a Coke and it costs you 20 Rand. It's so much more expensive. It's the same price. well, let's argue it's the
pretend it
same
is,
price,
yes.
right?
Inflation
Because
adjusted.
in real terms, inflation adjusted, it's the same price. So what we're expecting going forward across the multi-asset strategies is we're expecting lower returns. And we've had compression in yields in the bond space, in the income space. We would have an expected lower return in the equity space, in the credit space. But in real terms, it's the same thing. So we're still expecting strong real returns across asset classes. And the name of the game, as always in multi-asset, is diversification. So we try and spread ourselves all the way around the world. We have offshore currency exposure. We hedge some of that currency exposure back. That helped a lot last year. I've been doing a bit of analysis on where the rand is going to from here. And there are two things that the rand does. It does short-term performance. That's usually reactionary. So be it on news from Donald Trump or whatever it might be, short-term swings. And then you get the longer-term carry trade opportunity, the long-term interest rate differential, inflation, whichever way you want to skin the cat, you get a differential between us and the other currency pair. And if you plot that since the early 2000s, when we had the 3 to 6% band, it has tracked almost exactly at that midpoint of 4.5% on the depreciation on the rand. So where to from here? If we were to go on that same path, 3 to 6%, you could easily say that we'd be at 24 rand to the dollar into 2030, right? But now with the new SARB policy rates, we're actually expecting around 19 rand to the dollar in 2030. Now think of that as a South African planning your holidays. 19 rand to the dollar actually doesn't sound too bad at all. Going back to my earlier example, it's the same thing as it was before, but we have stability in South Africa, and that's the key.
I hope you're right, Rupert. Overseas holidays are very expensive. Hank, question for you. Duration was a key driver of returns in 2025 with the fixed income portfolios. How did you utilize that in the shorter end, the cash portfolios?
Yeah, great question. I think probably the key driver of returns last year was duration or having some fixed rate exposure across portfolios. Obviously mandate specific, and Conway alluded to a number of times around credit spreads being tight, so we would probably argue credit was not as big a driver, but there was a lot of upside and definitely alpha on the fixed income or the fixed side of the rate curve, right? So duration. As I said, depending on the mandate and the risk budget and how we think about portfolios, we utilize it differently. But as I mentioned earlier, on the front end, we took as much as we could. We fixed our rates as much as we could, and as those rates come down, you make some good cash for our clients and our portfolios. On the income fund, similar to what Rupert does, diversification, you've got multi-asset, you've got different opportunities, duration being one of them. We utilize it, absolutely. We were long bonds, we wrote that quite hard. Our view on bonds changed. That naturally means what we expect return from the different bonds along the yield curve changed. That means that if we're not getting paid enough for that risk in the income fund, we're going to switch. And that's what we did. So as I said, about third quarter last year, we took some of our risk off, we added some protection, and we just dumbed down and made it a little bit more conservative on the income side of things. Worked nicely. As I said, 11% for the income fund, real return, second best in 20 years. But did we catch the loss a little bit? Maybe not. But is that what we're here for? Absolutely not. We're here for real returns, not peer returns.
Okay, well done anyway. I think that's impressive. Second best or first, what was it, the best returns ever?
Second
best after 2024. Okay. Now we get to the really exciting stuff. Act 4, 2026 outlook, returns, risks and regime shifts. And the question here is for you, Basti. What are you bullish about in 2026?
I think fewer things than last year, to start off. I think if we look at the headlines, there's a lot of positivity, reform momentum, no load shedding, more political stability. Locally, we also managed to have a very solid budget now. Fiscally, we're in a much stronger position. Inflation target down is massive. So a lot of local, very good news. That's great. I think what's also good is supportive is lower interest rates, starting locally. But again, also Fed finally, we think too late, but finally they cut interest rates. So those are the things which are bullish, right? But in the end, it comes down to risk premia and how much room is there for risk premia to compress. And we think this year, unfortunately, there's less room for risk premia to compress than last year, simply because asset classes are measurably more expensive. So let's just start in the equity space. Again, we started very undervalued, now we overvalued. If we not just look at the PE ratio, but even for South African equities into something like the price to sales ratio, we're in the top quarter, so measurably expensive. If we look into the bond market, our real yields have dramatically compressed, even with the lower inflation, which raises the real yield, but the rally was like almost overshooting, so taking off more of the real yield than initially anticipated. And if we look into the currency, the rand also like started undervalued, massively rallied. So again, also risk premia have been taken off there. Globally, it's the same story. US equities, again, more expensive. So that strong rally has compressed risk premia. That makes us quite more cautious everywhere. So what's left to be bullish on? All
that was the question.
Yeah, so I guess it's all
where
the
are you putting the extra money?
So it's all the defensive asset classes. There are certain areas, like for example, Henk mentioned the income fund. If inflation stays at 3, income providers still giving us 8.5. So even after these strong years, you should expect more than 5% at least. Again, in real returns from the income fund, which I think is something to be quite bullish on. A second good asset class we like is US government bonds. So with all of that uncertainty which we've highlighted and the market not pricing it, there's potentially room for a disaster at some point, and then that asset class normally rallies. So we do like the dollar. We think it has sold off too much. So again, as a haven asset class, there's room for that currency to rally. So when there's a lot of asset classes expensive, there's also some pockets somewhere. So you just must look deep enough. But again, to Henk and Rupert's point, important to stay diversified along that journey.
Okay, Rupert said just now that we could have a situation if these real return targets come in, the RAG could be 19 in 2030, as opposed to 24 in the old inflation targeting regime. You're also saying you think the dollar is looking like it could rally because it's lost a lot of value already. Yeah. That's a longer term target, this is a shorter term target. How do you marry these two ideas?
I guess that's a good thing. The way we do it, especially in the balanced fund and generally in our investment process, that we have a strategic asset allocation, like a long-term outlook and a short-term outlook. So Rupert is exactly right. With this long-term outlook, the expected depreciation of the rand against the dollar will now be less. And we need to take that into consideration when forming our strategic asset allocation. What I was talking about is more the short-term tactical view. The dollar probably has been too weak, and we do think that there's room for a recovery. Given what we see priced for in terms of uncertainty, very little, very complacent, potentially a weaker global economy, too expensive asset classes, all of that speaks to eventually a stronger dollar again.
All right, Reza, you've given us a lot of information on bonds today. What's the outlook for 2026? Is it driven by SA domestic growth issues, or is it driven by the carry trade? What do you think?
Yeah, so the performance, I think it's good to note the performance in 2025 was quite stellar, but I would be very wary for any investors or interested investors to try and almost extrapolate that kind of, as we said, what sat behind that was a structural recalibration, right? So I think that your drivers of bond returns is going to be less almost that capital gain kind of yield compression type of angle. But that's not the only lever that we do have, right? So a big portion of our outperformance last year, at least a third of it was attributable to our portable alpha engine, which Romelin has touched on. So we do think that by its very nature, it's actually not dependent on the shape or the level of the yield curve. It's largely independent or orthogonal to that. So we do think that lever remains very, very much in play. So what I do think is that you're going to sit with a situation for the yield curve where it remains fairly range bound. There's going to be no, from the looks of it, no eye-watering moves either way. That does not mean that our outperformance will now be limited to zero. I'm not saying that. What I am saying is that in terms of what will likely take center stage this year, given the moves that we've already seen and given what is likely to happen to different components, that the portable alpha will rely a lot more heavily on that, right? So that is something that we do certainly see on the cards. You alluded somewhere there to growth, and I think I just want to add not on one sentence to the comments that Romelin was mentioning, and I think that this is a significantly underappreciated point, right? So the equities had a fantastic year, but what is actually also sitting under the hood of that is that you have a lower discount rate, right? So there's only two ways to change the value of a company. You can change the size of the cash flows, or you can change the discount rate. And because bond yields had actually compressed so meaningfully, it actually means that the discount rate, even if you do nothing else to profitability, nothing else to margins, nothing else to management, if you're sitting with a company that has a projected set of cash flows and now you're discounting them at a lower rate, the present value of your asset will go up, right? I'm not saying that is the entire story for SA equities last year, but I am saying it's an underappreciated point. So it's the issue about largely we'll rely on portable alpha as the lever. You could still see some of this almost kind of re-rating that I'm speaking of because discount rates change. And then on the growth side, as I say, I'm very, very optimistic that with, as we alluded to a little bit earlier on, with a lower cost of capital, we will see a little bit of a growth spur in South Africa, where firms, the propensity of them to want to embark on capital projects because you've got a lower cost of capital, that could actually speak to a line that has been horribly deficient in our national accounts for a long time. So I'd want to see that. I'd want to see us getting onto a much better growth footing. And then we can talk about all kinds of wonderful things that could happen to the bond market, but it's not our base case. It's hopeful, it's optimistic. Our base case is that the main lever for 2026 will be our very replicable and scalable portable alpha strategies.
Okay, so that's relative to your peer group.
Yeah.
But if you just looked at it from a pure beta perspective, are you arguing that returns in 2026 from the bond market will be lower than 2025?
Absolutely.
Okay, that's
Absolutely.
fine. But now, for equity markets though, the cost of capital has come in a lot. Is that reflected in our equity markets already, particularly SA Inc. stocks? Or do you think there's more upside? What are the opportunities in 2026?
Joanne, as Bastian and Rupert mentioned, we are constructive in our long-term equity view, but very cautious going into 2026. Equity markets are at their all-time highs, valuations are stretched. All those risks that I mentioned with Trump's tariffs and inflation and tensions in the Middle East still exist. But given those risks were present last year, no one expected the performance the equity markets had. And there's a famous saying, markets can remain irrational longer than you can remain solvent. Any asset allocator knows that not having any equity exposure can be detrimental to their long-term returns. Timing the market over the short term has been proven to not work, and you want to have some sort of equity exposure. And even if market returns are muted over the next year or there is some sort of negative performance, with the Prescient equity funds, you can be assured that there's a high degree of certainty that you will attain some outperformance even when the market is down 1% or more, as you saw last year, where we with helpful returns from reserves bond funds, we were able to get 3 to 4% positive alpha, putting some of the funds in the top 10 of the country last year.
Conway, your outlook for 2026 in the credit market? You've told us that spreads are pretty narrow and credit's expensive. What's your outlook?
So I think just to add a couple of things, Riza has mentioned a couple of times about the cost of capital. I've also mentioned about the green shoots and about the improving outlook. So if you add those together and the fact that I think the theme for 2026 is that of redemptions. There's about 167 billion rand worth of redemptions that are supposed to happen during the year. Eskom is a big one of that, with 160 billion issued in 2025. So there's going to be a lot of issuance that will happen, whether it's enough to satisfy all of the asset managers, income funds, bond funds, and credit funds. That is yet to be seen, and the impact on spreads. But the reality is, you've got a lower cost of capital, you've got 167 billion of redemptions that have to happen in this year. You've got excess demand for assets within this sort of ecosystem. So we do know there's going to be a lot of activity that's happening. But I go back to the thing that my broken record that I keep being is that this pricing for perfection or being expensive, selection is careful. So you have to know that when you invest with a manager, that they not only know how to originate opportunities, invest opportunities, fix opportunities when it's go wrong. And we've got a lot of experience and exposure in terms of all of those, that you would actually still be able to get that source of outperformance with selective and careful asset selection in the credit space.
Okay, so it might be a very exciting year for credit. Very busy.
Very busy.
Very busy.
Definitely.
Very busy. Okay. Hank, short end of the curve. We're expecting the SARB to cut this year, or aren't we? What's the view there, and what is your forecast for 2026?
Yeah, so SARB cut 4 times last year. We forget that, so 1% lower, which is great. Current market pricing is sort of 1 to 1.5 cuts priced for this year, so not a lot more relief. But Basti made a mention that, we do expect Fed to start moving. They've started in the end of last year. If they do that, sort of that story continues, then they could potentially be a little bit more in the front end. But we're very happy to keep keep them where they are. We get to earn those real yields. We've alluded to that a number of times today, and that's certainly still the case. But interesting, if we think about the income fund specifically, and maybe bring in the global income fund here, Rupert made some mention to it, Basti as well. If you look at our risky asset class views, they've turned conservative, but we do like the more sort of risk-off asset classes, US bonds being one of them, and we have started taking advantage of that. So a key change for us in our portfolios, and one to look out for in the year going forward, is having duration, but having US duration in our portfolios, and that for us is quite an exciting space to be in, and it certainly reduces risk in our portfolios, but is a nice lever for returns for us.
And it's also very much a contrarian call because everyone seems to hate bonds at the moment, so it'll be interesting to see what happens. We're now at Act 5, Risk, Resilience and System Evolution. Rupert, the question's for you. What grey swans, and apparently you want to use grey swans, could materialise in 2026, and what events are on the horizon that make you worried? And how are your systems designed to pick up on these risks?
So I use grey swans on purpose because black swans by definition are unknown. So it's the unknown unknowns, whereas the grey swans you get somewhat of an inkling as to something that might be happening going forward. So what are we seeing on the radar going into 2026? The big thing is geopolitical risk. So I've looked into some recent global leader surveys. The biggest thing that's come up in the risk surveys is geopolitical risk. And that compares to 5-10 years ago when it was things like climate change. So everyone's talking about geopolitical risk, and there's one man in the room, and I won't mention his name, that is the center of all of that attention. The point being that you don't want to have concentrated exposure, especially to, let's say, US equity market indices. Price to perfection is the key here. If we go around the table, we've heard that theme again and again, right? So credit spreads super tight, PE ratios very, very high, bond yields compressed. We've got price to perfection across a lot of different asset classes. So the key is to try and have protection in portfolios where you can. So by design, depending on the different portfolio structures, you can put protection in. You can put protection in by shifting your asset class exposures, and you can put protection in by actually taking on optionality. So for us, that's the key for 2026 is being cognizant that there are risks on the radar, mainly geopolitical. We don't know exactly what they might be, but they can happen at any time, and to position portfolios for that.
Could I also say that it's sort of more of a capital preservation mode, protect what you've earned, and substantially high returns for 2025, and you don't want to lose much more, you don't want to lose them. So you want to make sure you eke out some new performance, but don't lose what you've gained.
That's true, but I always think about people as being every day as a new investor. Mm-hmm. So there's this interesting thing in the hedge fund space where in a particular calendar year, often they'll de-risk towards the end of the year because they earn a calendar year performance fee and they already earned a lot of money. Now that impacts the people that have entered the fund in November because they no longer have the risk they're looking for. We have to carry the risk in the profile of each fund that we market the fund as. So a high equity fund is high equity risk, low equity fund, low equity risk. So we still remain true to the offerings of the funds that we have on the table. We just marginally reduce the risk. So we try and shift that risk around this table, quite literally around this table, to get the best return profiles, but still keeping that structural center the same, the core of a portfolio.
Okay. So I think we've all dealt with it today, but Basti, you get to kind of bring this all together. What are you most convinced of for 2026? Where are you most overweight and where are you most underweight? I think you have covered it, but just maybe summarize it for us.
Maybe to summarize and going up the risk ladder, so starting with Hank's funds, the most conservative funds, probably the place to be for the year to come because we still have very high real yields, very little risk right now, and to beat those returns is not necessarily that easy anymore. We spoke a lot about the strong bond rally last year. So if you want to beat the 8.5% of income provider, 8.5% being the forward yield, last year we did 11%, you would have to go out more than 10 years on the bond curve to just match the expected return or the yields, which is quite far. So that takes us to the second asset class, bonds, so where we would naturally be slightly more conservative. As Riza said, it doesn't mean that you can't earn a return. So 8.5% roughly on the 10-year, that's the yield. You'll get that, plus a little bit of portable alpha, plus probably us selecting, hopefully quite smartly, the best point of the yield curve, which is part of our process, and that worked exceptionally well last year as well. So you should still get away with 11% there, which will once again be great if inflation is at 3. But you don't need to take a lot of risk there. No. In the credit space, it's all about being conservative. So again, don't want to sound too pessimistic about the credit funds because you are mostly anchored to the front end of the yield curve, where in South Africa we've got those attractive real yields. So that plus a spread, even if that spread is very tight, you want to play it conservatively, exactly as Conway explained it, but it's still a good place to be. And then further out, basically multi-asset space, I guess Rupert mentioned it's all about diversification. We've got a lot of options here at the table and we will utilize all of them. And in the equity space, it's again EM more than all the other markets, so we think EM will outperform again. But other than that, it's more about being more conservative than the benchmark in the equity space, and we see that across regions. And then maybe last but not least, to just speak about the currency. So I mentioned earlier already, long term, the depreciation of the rand against the dollar will be less than before because the interest rate differential is exactly what defines that long-term depreciation. Interest rate differential has now shrunk with lower inflation expectations in South Africa. So the rand will depreciate less, but short-term, we think the rand will depreciate against the dollar. So tactically, you want to play against that. So yeah, lots of positions, lots to look forward for, but I think we've got the tool set and the tools and the equipment basically to get it right this year again.
Just one question on your dollar view. You mentioned you're more positive EM than DM, is that correct?
That's correct, yeah.
And yet you think the dollar in the short term could appreciate?
That's also correct.
Okay.
Yeah.
Do these two not normally work in counter-cyclically to each other?
They absolutely do, that's a fair point. That really depends what your starting point is, I guess. So I would say all else equal, a weaker dollar wouldn't necessarily have the impact which we would expect here, but the reality is that from a valuation point of view, developed markets are particularly more expensive than emerging markets, and we think that could be a core driver for emerging markets to outperform developed markets.
So just so I'm clear, you think a dollar could appreciate and yet you think EM could still do well?
We think so, yeah.
Because it's just from a starting point, it's
100%.
much cheaper than anywhere else.
That is right.
Okay. Rupert, just back to your multi-asset classes, are you doing anything new research in the pipeline, anything the market should know about in terms of your process philosophy?
Yeah, always improving the process. I think the key for us in 2026 is to consolidate the floor even more. So we are many professionals that sit at this table and across the floor, and we want to consolidate that view into one house view. That's what our role in multi-asset is. So to get a more granular view on every single asset class, all the way down to which issuance within the credit space, and then to reaggregate that up into multi-asset is the key. The reason why I say it's the key is that's how you really measure true risk in a portfolio, because you get a lot of latent risk that exists within portfolios, especially within multi-asset portfolios, but also within equity portfolios, where a portfolio manager says, well, I've got no emerging market exposure, but when emerging markets sell off by 10%, they lose 15%. So it's really about quantifying that risk in multiple lenses. How much exposure physically do you have to emerging markets, but also how much exposure mathematically do you have to emerging markets? Lots of tools we can use, so looking to build those out.
And is AI part of your tools that you're using? Are you
always
the
very center?
The very center. Okay. Basti, last question for you. What investment capabilities can we look forward to seeing in 2026 from you guys as a house? Is there anything you're working on that we should be excited by?
Yeah, lots we are working on, and I think it speaks for our innovation that that's the question we get most. So people expect ever fancier tools from us, which is cool. But I don't think that's key. But before I say that and explain that, I think the tools which will come online, we did a lot around natural language processing last year to look into what the Fed is doing, to understand the Fed better. That's extending ever further. So looking much deeper there, also looking into the beige book and trying to find stuff there. I think we have to sharpen up on the nowcasting, like the nowcasting of the US economy, which we do with a lot of AI. Hasn't been as good as we hoped it to be last year. It didn't really take away too much from the performance because there's many other factors which worked in favor and which worked. So that's fine, but that's an area where we will do a lot of development and improve. And last but not least, on the inflation front, we do also want to do like an inflation nowcasting. I think our inflation outlook last year has played out almost to perfection, with us saying tariffs will not be inflationary, with saying productivity will bring down inflation, with us saying inflation will surprise on the downside. All of that came true, which is awesome. But we want to develop that even further to really like nowcast what US inflation and potentially even South African inflation is doing almost in real time. More important than all of these tools, I think, is exactly what Rupert said. you need to use the technology out there, and it's not about creating fancier AI tools. It's more about working with AI to get the best out of the processes for our clients. So not everything we do and not everything we work on is always seen in like a fancy chart or a fancy tool, but I guess in the end it comes down to the performance the clients experience. And I guess if we look back into 2025, that performance which our clients experience speaks for itself.
Thank you very much, everyone. I think this has been incredibly insightful, and I hope everyone stayed from Acts 1 to 5. Thank you.
Right, thanks everyone for listening in. We've run a little bit over time, but we'll try and answer a few questions for those who have the time to stay around. And for those questions we don't get to, we'll follow up on email. So the first question that we've got through on the chat, this one is for Riza, perhaps slightly more technical, but the detractors' critiques to the revision of inflation targeting often cite that this is to do with administered pricing within South Africa. Well, what is your take on that?
Thanks, Rupert, and thanks for the question from our viewers. Yeah, so it's a popular question, and I just would mention anecdotally to start off with that if we look at those critiques that our inflation process is largely administered price-driven, all of those same points could have been made in 2017 when we migrated from a 6% inflation economy to a 4.5% inflation economy at the time that the quarterly projection model was first tabled. And effectively, inflation migrated from a seamless 6% to 4.5% without any major hiccups and without a very punitive hiking to it. So it's all about expectations, right? So the idea is that it's a misconception that by moving to a lower inflation target that we are in fact, or the SARB is in fact trying to control every single inflation print. What actually matters is the perception of their so-called reaction function. And what matters is, in fact, what long-term inflation expectations do and how they are able to control that process. Exogenous factors like an oil price spike are inherently self-correcting. Oil prices spike, aggregate demand actually drops off, and inflation actually lowers out of its own accord. So you don't have to act in a pro-cyclical way to hike rates at that same time that you have an oil price spike. So it's largely that kind of coherence in your reaction function that guides long-term inflation expectations, and that is what the SARB is trying to control, not every single inflation print.
Okay, second one we got here is, what are your thoughts on allocating offshore portions of portfolios to offshore managers? I guess that one comes to me. So that is something that we deal with quite a lot in chatting with clients, and some clients do like to allocate towards specifically offshore dedicated managers, some of them sitting offshore, some of them just specialist teams in South Africa that have offshore portfolios. Nothing wrong with that at all. We try and cater for everything. So, for example, in our balance space, we've got a global, i.e. South African and global balanced fund. We've got a local balanced fund, which only does South African asset classes. And we've got a global, i.e. sitting offshore balanced fund domiciled in Ireland. So we try and cater for all of those. And then likewise, from our equity components, from our income components, we run funds offshore. And I think the benefit, as you'll know, having seen those who've seen our systems, the benefit is that we can sit here in Cape Town and we can run global portfolios because we're systematic managers. So we don't need to visit, let's say, a company in New York to do on-site due diligence. We run things in a systematic fashion. So I think that really is something which plays into our court. Next question, perhaps a bit more technical on the income side of things. We'll give it to Conway. Describe the role of 81s in an income portfolio.
I think the question is probably going from a risk perspective and why it should be in a income portfolio, and also very importantly in a short-term portfolio. So I think just to disaggregate the two, the first thing is when we look at instruments, every instrument is on our radar based on concentration and diversification limits. So we look at the risk, and we look at the return of an instrument and see if that is appropriate for a portfolio, considering mandate and regulation and legislation. I think that is the first starting point. Then the second one is how we are actually strategically positioned. Right now, we're looking at our credit cycle indicator. We're in the neutral position, which means that we are generally bullish on banks. It doesn't necessarily mean we only have to be buying bank senior. Because we have a strong view on banks, we can buy bank senior, we can buy subordinated, we can actually purchase those 81 instruments for a host of portfolios. Then if there's a risk or a question on whether this is appropriate for a short-term portfolio,
as again, we are constrained by a mandate and legislation. A short-term portfolio can't buy a 5-year instrument, as an example. So that won't necessarily happen. Where it becomes more relevant is that as it rolls down the curve, if there is less than a year left, then if that risk makes sense for a short-term or income or a money market portfolio, we will include it. And then for our most defensive funds, we will not put that instrument in it unless it reaches the call date and we get a sense that actually allows us to purchase it. So we're very selective in our approach. The diversification part is very, very important for us. No single issuer can be more than 4% as an example. That's our in-house rule. And that has literally helped us when it comes to credit events and the likes to make sure you don't have all your eggs in the same basket. And then again, it's completely correct that in a high stress scenario, these are designed to absorb losses. So we need to make sure that we have a proper view on the actual issuer and the instrument, that the pricing stacks up, that the mandate and the legislation allows us to hold those instruments in the funds.
That's probably all we've got time for today. We've got a couple of questions in the lineup. We'll try and get to them individually via email. Just to say thank you for tuning in, and hopefully we'll see you for our next update to the end of Q1, which is in April, and have a great day further.